For US 10 years, it looks about right. Here, 4.5% and higher, it starts to look attractive. We got close to 5% at the end of last year, and that looked like a clear buying opportunity to us. When you look outside the US, again, in the baseline, I think everything looks pretty reasonable, but the risks, the balance of risks, I think is towards outperformance of non-US duration. So again, at Pimco, we think that Australia, Canada, the UK all look quite attractive. Europe looks okay, and there is the potential for widening of spreads, and then more in terms of the front ends of curves, more from the central bank. So we think at the moment it makes sense to tilt a little bit towards non-US duration. But then overall, fixed income looks attractive here. You were talking earlier about uncertainties in the equity market outlook with high quality fixed income. High quality bond funds give you 5, 6, maybe 7% yields. This looks very attractive at a time when there is a lot of uncertainty in the outlook, and the recession risks. Certainly in the near term, recession risks look reduced in the US. But if the Fed is not over time able to cut rates, you start thinking about the slowdown further out in the US as well. So from that point of view, high quality fixed income, I think, looks very attractive here.
You say the slowdown further out in the United States. Andrew, how do you price in the concerns around the U.S. budget? In just 12 months' time, we might have a different president, and the first thing on their docket, January 2025, is dealing with the debt ceiling yet again. How do you price that in right now?
So I think that so you can see where deficits are in the US at a time of basically full employment in the US. So you can see the significant structural deficit in the US, uncertainty around the election. But regardless of who is president, I don't think you're going to see any significant change there. It'll be interesting, of course, the composition of the House and whether it's divided government, but overall it's hard to see much shift in terms of this structural US deficit. I think from that point of view, it makes sense for us to be in the 5 to 10 year part of the curve in the US and be underweight the longer end of the curve in case fiscal concerns start to weigh on the market. You had a demonstration last summer of the steepening of the curve, the underperformance of the long end of the curve in the US, and I think it's worth being in the 5 to 10 year part because you could see higher term premia in the US. I always think you're not going to get an exciting adjustment like we had in the UK 1 or 2 years ago. The US is a more important reserve currency, very liquid market, but the probability of a higher term premium in the long end is something that's a good idea for active managers to guard against.